But let me go ahead and hit record so we can get started. So welcome everyone, and thanks for joining us for our last small business seminar for 2023 on income tax updates and strategies to reduce taxes in the new year. We promise we'll be sharing some helpful information and keep you entertained for the hour. So we will have time for questions at the end of the program, so you can either type them in the chat or you can save them until later when we get to the Q&A. And now I would like to introduce our speaker for today's event. Barry Fields has over 20 years experience in tax consulting and auditing in public accounting and private industry. Barry is a partner with Bormel, Grice, and Huyett, where he's worked for the past 14 years. Barry is very active at the Chamber, serving on several of our committees. He's also a member of our board of directors and our treasurer for 2024. He is also quite the comedian. So I'd like to turn it over to you, Barry. Thank you.
Thank you, Christy. Thank you, everyone, for attending this morning. Thank you, Chamber, for having me. I've been doing this for a few years. I don't remember how many. Try to do this every year, give an update that's helpful and useful for people. The kind of breaks into two categories of somewhat of just general tax information as well as tax planning tips, because if we have this information and can't use it, it's not very helpful. Just want to start a little bit by the structure has changed a bit that we've done for a couple of years. I would think one of the first years I did this was around 2018 or so, right around the time of the what we call the Trump tax cuts, the Tax Cuts and Jobs Act of 2017, and that changed a lot of the rules. So my handout that I had, which is still my starting point, was a couple of pages of some of the new rules that were drastically changed as compared to the older rules that we were used to. Soon after, coronavirus came into our lives, and Congress there were several, relief measures to try to help people, incentivize people, keep the economy going. CARES Act, others, and at that point, a lot of those rules were. Some of those rules suspended some of the changes. Some of the rules enhanced some of the changes. Some of those rules were just temporary measures, and a lot of that expired. So each year, I would build on top of my handout. I've gotten rid of a lot of that's just expired. If someone hasn't filed an older return, that's not what we're covering today. So the things that are expired, I've eliminated from the training, obviously. I've left the first couple of pages when we get to the handout. Some of you should already have it. Everyone should already have it or access to it. And I will share, I'll refer to it today. Since we're on Zoom, I will have the handout up. A lot of that, the first couple of pages with the 2017 Jobs and Tax Cuts and Jobs Act is still relevant, except that it expires at the end of 2025. So can't believe that was a 10-year. It was a 10-year rule, and we're almost at the end of it. A lot of times we like to play, crystal ball, and what are we going to predict? Something that's going to expire, is it going to be extended? Something that didn't make it the first time, is it going to be enhanced or added to it? We're all reading the news these days. There is nothing predictable about what might happen with the IRS and the tax code in 2 years from now. So all we can do is work with the rules we have, which is always best advice anyways. And with that, we're going to get started. So I'm going to cover some of the rules that are in. I'm going to cover the rules from the Tax Cuts and Jobs Act a little bit. Go through that. Talk a little bit about, and then some of the green tax benefits, for lack of a better term, the energy credits that are part of the Inflation Reduction Act, and then a few other miscellaneous topics regarding retirement planning and some other items. A couple quick ground rules I like to always say is if I'm talking about something, if you have a question about something I just said, if I'm saying something and you want me to enhance it or repeat it or something, by all means, interrupt, raise your hand on the screen, chat the question or something, or even speak up, unmute yourself and speak up. If you need clarification or want to enhance a topic, please feel free to interrupt. If it's a question coming out of nowhere, changing topics, please hold them to the end. I'm going to try to get through all this a little quicker than I normally have in the past, since so many things expired with coronavirus, and then talk about whatever other people want, answer questions, etc. So with that, I'm going to share my screen. This is the handout that everybody has. And we'll go there, and everyone can see Everyone can see the handout. Okay. I'm going to try to keep looking at the screen, so bear with me every now and then. I just look down rather than at a different screen. So like I said at the beginning, this is where it starts. We're using the Tax Cuts and Jobs Act, which was passed in late 2017, effective for 2018. This, if everyone remembers, we call it the Trump tax cuts. These are they lowered overall, these rules lowered individual and business income tax rates. And in exchange for the lowering of rates, a lot of other areas were changed to try to, they couldn't just lower taxes, also had to lower, on the individual side especially, they also had to reduce some of the benefits available to try to get the math to work. So what I listed here are some of the tax brackets. I'm not going to go through them or repeat them, but right off the bat, these are the brackets. And the U.S. tax system is what's called graduated. If someone is in the 24% tax bracket, that doesn't mean whatever your earnings were, take it times 24%, and that's your federal income tax. Your starting point is the 0% bracket, and you pay the full amount in each bracket up until you get to the next one. So, for example, using the 24% bracket as a starting point, if you made over 190,750, that is the starting point of 24%. Everything before 190, this is taxable income. This is not your gross wages. This is not your gross, what's called adjusted gross income. These are your taxable income. So if your taxable income is 197.50, everything before it went through the 0% bracket, the 10, 12, 22, and everything after 197.50 is at 24% up until 364,000. So there's a big spread there. That's why I grabbed that one on purpose. And if you can even see from the 22 to the 24, going from 89 to 190. So right off the bat, as far as tax planning, tax thoughts, tax ideas, if you're ever in a situation where you're considering accelerating income, maybe taking something out of a 401k plan, you're a retiree, you're taking more than your required minimum distribution, or anything of those, if you're doing anything to accelerate your income, one idea is to keep an eye on your tax bracket so that you're not paying in the next bracket. That's right off the bat. If anything, take something in December and take more in January to spread it over 2 years. I'm not going to give examples. I'm not going to talk about numbers, but that's some of the importance of knowing your tax brackets. That doesn't necessarily apply to everybody, but one little thing to know about. In addition to the changes of the tax rates for individuals, and all this is for individuals. I'm sorry. Right now we're covering individuals, and everything I'm talking about expires at the end of 2025. I think I already said that. Another area, they significantly increased the standard deduction for individuals. So it was the old rules, and this is what will become the old rules will come back starting in 2026. If you're single, you get a standard deduction of 6,350, and the old rules was 12,700 for married filing joint. These numbers were adjusted for inflation, so those won't be the starting point. They'll be higher than that in 2026. But now, adjusted for inflation, going into 2023, singles is 13,850. You see the jump from what was 6,350 for a single is 13,850. And for married filing joint, 2023 is 27,700 instead of 12,700. Significant difference. And one impact that had, which was by design, is many more taxpayers now take the standard deduction rather than itemize. You either itemize, which is you take other deductions, I'll get to that in a moment, or you take the standard deduction, which is just a blank number. You grab that number and you can use that. And you're going to use whatever is a bit more beneficial to you. And like I said, so in many cases, the vast majority of people are now taking the standard deduction. Sorry. Flipping over to itemized deductions, I call it the big three. You're allowed to deduct your your state and local income taxes, any mortgage interest with rules, mortgage interest on your home or a second home, and charitable contributions. For others, those are the big three that most people take if they itemize. And the fourth one that's most popular, the next one would be medical expenses. Starting with real estate, state and local taxes, that includes your state income taxes plus your real estate taxes if you own your own home. Part of these rules are your state and local taxes are capped at $10,000. So if you're in a higher tax state, or depending on where you live, you own your own home as well, your state income taxes plus your real estate taxes on your home, you can't take more than $10,000, deduct more than $10,000. And that same number applies whether you're single or married filing joint. So what you take that 10,000 plus mortgage interest on your home or a second home with limitations, plus charitable contributions. And when you add all that up, going into 2023, if that is less than $27,700, you're most likely going to itemize. I'm sorry, you're most likely going to take the standard deduction. You're going to take the 27.7. There's a little catch to that though, because, and I'm going to, in Maryland, and I'm not sure about other states, Maryland has a rule that says if you take the standard deduction, you must take, for federal, you must take the standard deduction for Maryland. The standard deduction for Maryland for married filing joint is $4,500. So you're going from 27.7 down to about 4,500. You're losing a lot of the deduction. I'm not going to get into math and the nuances and the differences of what's different between the two. But if you're taking the standard deduction for federal, you're taking a lot less for Maryland. And so there's something called optimizing, or which I'm doing here where I'm talking about these bullets, forcing or optimizing. If you have enough deductions to take, you can choose to leave a little bit on the table for the IRS for federal. Don't take 27.7 and you have others, say like 26, I'm making up a number, deduct only 26 or 25. You're losing some deductions for federal at the federal rate, but you're picking up a lot of deductions at the state rate. That difference overall, when you combine everything, could lead to an overall lower tax when you combine your federal and state. And that's what we mean by optimizing in this third bullet. So just, it's a little complicated, and I'm going over it a little quicker than I have in the past, because as the federal standard deduction is adjusted for inflation, that number keeps going up. Like you can see next year is going to be, for married filing joint, it's going from 27.7 to 29.2. That's a big jump. That's all we've been hearing about the last year or two with the inflation. These numbers are adjusted for inflation. And so that's taking the current situation we're in with the higher inflation, and that's taking that into account. So it's getting harder to what we call optimize, because that spread is getting larger and larger. So you're leaving more federal deductions on the table just to take state. I'm gonna move on.
Barry, can I just ask one of the questions in the chat? Ross is asking, is there an addition to the standard deduction for those over 65?
Yes, there are two categories. Over 65, there's an additional standard deduction for single, over 65 and or blind, and blind rather. So and if you're both, if you're over 65 and blind, you get to double that. So the answer is yes. And it's yeah, I'm just trying to not read, so sorry about that, Ross. So the item, we talked about the real, we talked about the combined $10,000 for state and local, the mortgage deduction. If you own your own home or a second home, the rules decreased from $1 million. You can deduct up to $1 million, the interest on $1 million for your home. Now it's down to 750. If you have a home from before these rules changed, before December 2017, you're still under the old rules, even if you refinance. Anyone who remembers that you used to have a $100,000 home equity line of credit, you can deduct that. Now that is no longer deductible. Mortgage interest is generally deductible as long as it was used to purchase your home, or if and it has to be secured by the home. You can't borrow it from a friend, a neighbor, family member. The mortgage must be secured by the home. And if it's also for home improvements, that $100,000 line of credit used to be generally for whatever you want, as long as it was a home equity line, not just a line of credit, but a home equity line. You're allowed to deduct up to the interest on up to $100,000. Now it's not really a home equity line, as long as that loan was used to improve the home. You can still deduct that interest, but there are rules and limits. And again, a lot of this stuff kicks back to the older rules in 2 more years. The charitable deductions, it used to be what's called 50% of AGI. Now it's 60% of AGI. That means if your AGI is $100,000, you can deduct up to $50,000. Now it's $60,000, 60%. We don't really see a lot of it that high, but that's for, that helps a lot of the higher income folks making large charitable contributions. Itemized for medical bills. The one thing to note is the rules originally changed the rule that you could deduct only up to 10%, the amount in excess of 10% of your AGI. It is now permanently 7.5%, even though tongue in cheek, I'd like to say that nothing's ever permanent. And then there's just a smattering. We all have the handout. I'm not going to go through every bullet. Those couple were the four for itemized deductions, and the Tax Cuts and Jobs Act did doubled the child tax credit for eligible taxpayers from 1,000 to 2,000. We're on to page 2. Dependent care, if you need to work and have your children are in daycare, that's what this one covers. One thing I'm going to keep moving along. The alternative minimum tax. It was always, prior to this rule, a lot of people got caught in the trap of AMT, alternative minimum tax. You compute your tax one way for regular tax, compute it another way for alternative minimum tax, and you got to pay one, the higher of the two. And then, so it's not that they did away with AMT. The original rules for AMT were not adjusted for inflation. And so they've adjusted those numbers. They increased the base of who's subject to AMT, and it eliminated a lot of people. We're just going to kind of leave it at that. We haven't seen it most people haven't seen it for a few years. Happy to answer any questions later if you have questions on alternative minimum tax. On the gift tax, on gifting, this was a huge jump, and we're definitely going to hear this. There's going to be a lot of talk about this one as the rules are set to expire. The old rules it was originally way back when I remember, if I recall correctly, many, many years ago, $600,000 of your estate was allowed to be excluded. Then it was changed to $1 million. Then it was changed to $5 million. It's now up to $11 million. If someone, and the numbers are adjusted for inflation. So if someone passes away, the first $11 million of their estate is excluded from federal estate tax. And if you're married filing joint, between you and your spouse, it's $22 million if everything's titled properly. That's a huge sum, and that is scheduled to. That's where we're at now, and it's scheduled to revert back at the end of 2025. Well, actually, and that was adjusted for inflation, so that 11 million is now 12.9. It's scheduled to revert back to 5 million in 2026. So you can just picture the politics and the news we're going to hear as we're approaching that. It's supposed to revert back from 12.9 to 5 million, and adjusted for inflation in 2026, they're predicting it to be about $6.5 million. I'm not sure about you guys, but I should only hope this applies to me at some point. Then what is more relevant for everybody is you're allowed to people can give a gift every year without falling into the gift tax rules, gift reporting. That number, you can give $17,000 to people can give a $17,000 gift this year, $18,000 in 2024. If a husband and wife each want to give a child, help them buy a home or something, and not have to, it's not avoiding the gift tax rules. This is within the rules. It's a report. You don't need to report it. In December, a husband and wife can each give a child $17,000. That's $34,000, and turn right around in January and then give them each $18,000. That's another $36,000. So within a couple of days, couple of weeks, you could get somebody some money to help, the down payment on a home or whatever it is that they need, rather than doing it all, in December in one lump check or something. There are ways to, again, not avoid the gift tax rules, but to not have to report the gift and not account for it in the long run. Those are your individual rules currently, and that's, like I said, that's all going to revert back to, and that's why I left some of it in here. What's going to become, because 2 years is faster than we think. We're going to go. We have a year of election, and as soon as that election comes next November, we're going to start hearing very quickly. They're going to start talking about this expiring and what should be extended, what should go, and I can't even predict what could even come of it. So on the business side, one of the largest cuts was the corporate tax cut went from 30. It was graduated a little bit, but it very quickly got to 35%. And now it's down to 21%. That's a pretty large number to cut 14% off the corporate tax cut, off the corporate taxes. Those are for corporations, C corporation, all the ones we read, Microsoft, et cetera, and small ones. a lot of self-employed people are not C corporations. They operate as either a partnership, sole proprietorships, S corporations, which is also a pass-through entity. So they don't get those entities. A lot of smaller businesses don't get the benefit of that tax cut from 35 to 21. So what they did instead was the next bullet here, qualified business income. They came up with a new rule bringing the business income only. A pass-through entity, self-employed people pay taxes at their own rate, at their individual rate. On the first page, we talked that the highest bracket is 37%. So if someone's in that 37% bracket, their tax on their self-employed income is at 37%. So this kind of helps offset that business income with the business rates. So there's a 20% deduction allowed for businesses organized as S corporations, partnerships, LLCs, or sole proprietorships. It's trying to bring their marginal rate down to 29.6. It's not perfect, but it gets them pretty close because it's the business income only. Lots of rules go with this. What is allowed, professional services or consulting businesses are not eligible for this. When you get over to a higher income service providers are not eligible, except for architects and engineers. I think that's a result of good lobbying. I'm kidding. I think a lot of times the architects and engineers are partially why they're hands in on the real estate world, on actually building something, as opposed to just service providers. Also, there are rules once you hit over, like the taxable income over 364,000, you start phasing out what's allowed of that 20% deduction from your business income, unless you have employees or assets, and then you're getting into very complicated rules with lessers of and et cetera to see what your 20% deduction would be. But if you read the paragraph, generally it's as long as you're under these income limits, you get this 20% deduction. Moving on to those are tax rates and deductions. People have talked about accelerated depreciation for years. There's something called section 179, that is the tax code section, no different than a 401k. A retirement plan is section 401k. A college savings plan is section 529, and this is section 179. A business can deduct some of the personal property, equipment, fixtures, etc. They can deduct 100% of it in the year of purchase. There are certain rules, there are limits. Those limits used to be 25. It used to be 25,000. A couple times it went higher than that. Different rules. It is now you're allowed to deduct $1 million. You're allowed to deduct 1 million of additions. That's a huge number, and that's also it's indexed for inflation. So now it's 1,160,000 you can deduct. You cannot take this deduction to a loss. So if your business has $1 million of income and you want to take the full 1,160,000, you're limited to the million. You can't take this into a loss, and also smaller numbers obviously apply as well. Bear with me. That's section 179. And then there's also something called bonus depreciation, different sets of rules, different categories. And that used to be, if anyone heard about the 100% bonus deduction, that's been around for a number of years. Starting this year, 2023, the rules are going to start ratcheting down, where what was 100% bonus is now in 2023, it's 80%, 60% in 2024, and so on. And then there is no bonus depreciation after 2026. And 179 is still here. 179 will apply. And these rules, by the way, the $1 million deduction I just discussed, that's a permanent rule. I think I forgot to say that before. The individual rules expire at the end of 2026. The business rules we're talking about right now, almost all these rules are permanent. The one rule in the business on this business page that's not permanent is the 20% qualified business income deduction, the bullet just before this one. That will expire at the end of 2026 unless Congress makes nice, discusses it, and comes up with something to extend it or something. That's 179 and bonus depreciation. And then there are also limits. You can't just buy a car and deduct it. There are limits on how much, if it's generally it's when it's used for personal and business is what these rules are, or also smaller passenger autos. If you're buying a much larger, heavier truck, SUV or truck that's generally just used in your business, these limits don't apply, the different rules. So that is the depreciation. Also business interest. If you're taking loans for your business to operate, the deduction is limited. People can't just take a large. I remember during President Trump's during campaigning, he talked about this. You're taking a large loan because you get a large interest deduction. Sometimes it just doesn't make sense. You're putting the tax code and deduction ahead of business sense by leveraging yourself so much. So the rules limit a business interest deduction limited to 30% of your business income before taxes, depreciation, etc. It's a little bit of a complicated calculation to see how much you're allowed, but it could be limited. That will come into play, especially for a taxpayer who may have a high business loan, and then maybe not such a great year, and the amount of their income is lower, and then suddenly this could kick in, surprise you and kick in and limit the deduction. Net operating losses, if you're operating at a loss, usually you get a benefit. It used to have rules where it can be carried back. You can't carry back net operating losses anymore. You can only carry them forward. This is also permanent. Like-kind exchange rules, we're not going to go into these, but if you trade, generally if you're trading property of like kind, you can defer the gain. It used to be all sorts of property, real estate and personal property. Now it's only real estate is eligible for a like-kind exchange. And one of the big ones also that really affects a lot of people is the meals, what used to be called the meals and entertainment deduction. There used to be a 50% deduction for meals and entertainment. Entertainment has been eliminated. You cannot take any deduction for entertainment, only for meals. And even within the meals world, the rules have been altered a little bit. It used to be the day where you took a client out to a baseball game or some other sporting event, possibly out to play golf, and you ate and you attended the event, and it was all considered meals and entertainment. You deduct 50%. You can't deduct the other 50%. Not exactly sure where the 50% came from historically, but the way I explain it is I don't get a deduction for me. I'm going to eat anyways. I'm going to go to the concert or the game potentially anyways. I don't get a deduction for me, but I'm taking you for business purposes. We're going to talk about business, so I get the deduction for you. I don't know if that's true, but it's a good way to how I explained it and remember it. I don't know if that's the politics behind it, but it actually, it makes sense. It's a good way to remember it. So the entertainment portion has been eliminated. If you take a client to anything, that ticket price or the entry fee is no longer deductible at all. If you have food at that event, or you're just taking someone out to eat and a business lunch, that's 50%. For a couple of years during COVID, that became 100% when restaurants were really taking such a hard hit. That 100% came back only for restaurant meals, but that's expired. So for 2023, anyone who's been doing this for a few years, bear in mind what was 100% for 2021 and 2022 is now back to 50% in 2023. That's kind of like the Tax Cuts and Jobs Act and where we're at today is like the base rules. Moving on to some snippets of the Inflation Reduction Act. This was last summer, or I guess a summer and a half ago. The big feature here, this was the one, if anyone remembers, there was $80 billion set aside to modernize and assist the IRS. That was a big brouhaha. There's still some fights over trying to cut that. As a tax professional, forget about the politics for a moment. I'm going to tell you that the IRS needs help. I'm not putting a dollar on it. I'm not suggesting they go audit. Right now, the IRS generally can't do its job. When I call the IRS, clients get a tax notice or a tax letter. For some reason, it is really difficult to clear up the issue. They're understaffed, overwhelmed. Some people can say that's a good thing. Some people say that's a bad thing. I'm just going to say it just makes it very hard for me to help people who sometimes the IRS makes mistakes. We all make mistakes. Sometimes the tax person prepared their own return. They made an innocent mistake, and now it's very difficult to correct. Sometimes the IRS makes a mistake, very difficult to correct. If you try to call them up, there's a tax practitioner line. I call them, very hard to get somebody on the phone. You write a letter, you might get a response in 6 to 8 weeks, saying we're looking at this and we'll get back to you another day. And then you get another one in another 6 to 8 weeks. That's why calling is very helpful. A lot of times it's very simple to just make a phone call and resolve issues. It's just gotten very difficult. So I do hope at the very least, at the customer service side, we see some improvements. So that's where some of the money was for the Inflation Reduction Act. Sorry for that little soapbox. Then another area was, a lot of it was the green. We're hearing about this today. One of the things that makes the green tax benefits is a lot of these are going out till 2032 and 2035. So right now, people may not be spending their money. The times are changed where we're in this little, whether we're saving our money for one reason or another, or not sure what's going on. It's still only 2023 going into 2024. What we're about to describe and talk about is good. 100% of these, 100% of these rules are generally through 2032, and then some of them are going to start phasing down to 2035. But we're going to see this still for another 10, 8 to 10 years. So these are not going away unless Congress acts on it and does something. So the residential clean energy credit. I'm not going to read this. We're not going to go through all this. But just the residential clean energy credit, think of this one as you're making power. This is solar power. This is this is solar power, heating power, fuel cell power. You're producing power at your home or a second home or a vacation home for generally any kind of residence that you own. This is not a business. This is for individuals. You get the 30% credit on that. That was the rule a number of years ago. It's back. It's been back for about a year now. So if you put solar panels on your house, 30% tax credit. We discussed deductions earlier. If you have gross income of $100,000 and you have a $25,000 deduction, you now have income of $75,000 and you're going to compute your taxes. That's a deduction. If you flip this around, if you have gross income of $100,000 and you have that same deduction of 25, well, you have no deduction, but you're at 100, you compute your taxes. This is $30,000 of dollar for dollar tax, as opposed to a deduction before you compute your taxes. Tax credits are much more valuable than tax deductions. So if you solar power on your home, at your home, is this residential clean energy credit. You get 30% of that. And that's also subject to, that goes against AMT as well. So when these rules kick back, and these don't expire. So when the Trump tax cuts of 2017 expire, and if AMT is not fixed and it comes back and bites us again, these credits will still be able to offset AMT. The way back when this was an issue when these rules first came around. The energy efficient home improvement credit. This is what's called the non-business energy credit. This is for stuff. This isn't to make power. This is for insulation. This is for windows and doors. Everyone, depending on the bucket, you're capped at $1,200 a year. People may remember there was a time when it was a $500 lifetime credit. That has gone away. Now it's $1,200 a year. There's no one thing that you're generally going to get the $1,200 a year for. It's different buckets, but you can do doors one year and do more doors another year. Stagger it, windows, skylights, insulation, etc. That's your energy efficient home improvement credit. And then the clean vehicle credit is electric cars. The cap is still $7,500. That's what it was. They changed the rules. They made it harder. They've opened the door up. They're trying to force the price of electric vehicles down. So higher income folks are not going to be able to get this deduction, and more expensive electric vehicles are not going to get this deduction. And they're also moving manufacturing to the US, North America. So a lot of nuances to being able to get. It's harder to, at this moment in time, it's a little harder to get this credit than it used to be. But the hope is to bring manufacturing here, or when I say here, to North America for components, for the battery, for the vehicle, spur the economy here through manufacturing, and also lower the price of the car to make it more widespread and make it eligible for not that the more eligible for the credit, but more affordable for the cars. And it used to be this was not available for used, but you can now buy a used clean vehicle, and there's a limited credit available. Again, the AGI limits apply, and it's not the full credit. It's a lower credit. That's, it's all right here. I just, we're running out of time. I want to leave plenty of time for questions. I just want to jump into this last page. Everybody good so far? Go through Christy or Kim. I can't really see everybody. So if anyone has a question, please let us know. moving on, this is just the last page, a little smorgasbord of some topics. The retirement plans amounts, one of the easy, how do you save taxes? Unfortunately, this day and age, it's the only real way to save taxes is to spend money. You can't, if you don't spend, you gotta spend money to get a deduction, you gotta spend money to get a credit. So one of the easiest ways to save today's taxes, which is to save your own money. Move money from your left pocket to right pocket, it's still yours. You just don't get it for a little while. So by all means, if you have if you're able to maximize your retirement savings, if you can, because it's still it's your money. Everything else you're generally giving to somebody else. So here are the limits this year. If it's an IRA, it's up to 6,500 in 2023 from 6,000. 401ks, the cap is 22.5. And there's a catch, they call it the catch up is 30,000. I've included the 2024 amounts here. So if you have any, to make changes through your HR, through payroll, to make the changes if you're able to increase it that little bit and take advantage of it. And then this last line is for self-employed. If you have a simplified employee pension plan. I'm not getting into the rules and the nuances, but look at the staggering difference of how much you can save if you're self-employed with one of these plans. You can really save a lot in money. Again, this is in the handout. This is the last page of the handout. Required minimum distributions. The rules are changing as we're getting older and as the population's aging, they're increasing the rules to make that you're required to take a required minimum distribution. These are all kind of in plain English right here. I'm not going to repeat them, but over time it went from 70.5. It used to be 70.5, and starting in 2032 or the year starting in 2033, it's going up to 75 years and in like phasing in between. And there's some rules for catch up. If you make catch up contributions, be on the lookout. If your AGI is over certain limits, right now it's 145,000, and it is indexed for inflation, then the catch up piece cannot go. It's not deductible through a regular 401k. The catch up component has to go through a Roth. That was originally supposed to take effect this year, but through administrative burdens and hurdles, such as many plans don't have a Roth feature. So if you have a traditional 401k without a Roth and you want to do the catch up, your plan wouldn't even let you follow the rules. So they extended this out a year so plans can catch up. Meals update is what we spoke about before. The 100% is now 50%, but not necessarily meals. But what's in here is if like team building, if an employer is doing something, for all their whole team, not just one or two for lunch, but all your staff, doing some kind of team building exercise, things that benefit the employer, those are generally 100% deductible. It's not entertainment, it's not meals, it's expenses for the benefit of the employer. Don't just go spending money. There are rules within that. I'm happy to answer questions later. But just know that, working with your staff as a team is deductible. Taxation of cryptocurrency has always been a hot topic, and it continues to be so. It's an area the IRS is cracking down on and looking into. Just think of it as, even though it's got the word currency, cryptocurrency, and we're thinking of it as, no different than trading in pesos. It is different. Right now, the rules are if you buy Bitcoin or Ethereum or anything, it's no different than buying a stock or a mutual fund. You buy the crypto at some cost. That's called your basis. You sell the crypto at a gain or at a loss. You have a capital gain or loss. You follow the rules, whether it's short term or long term. It's treated as an investment. No different than if you bought actually into a company and bought stocks or a mutual fund. Pretty straightforward, except a lot of people are doing things online and multiple and many trades a day. I don't know if this is as common as it was just a year or two ago, because a lot of the values have crashed. A lot of bad press, but those who are still, following along in the crypto markets, just be aware of the tax reporting requirements. Identity theft, I highly recommend both of these. And there are links. If you get the PDF, the link should work, or just copy and paste it. You can create an online account. We just discussed earlier how it's getting harder and harder to reach out and talk to the IRS. So if you have an online account, you can go to it. You can't really resolve matters, but you can see that any payments, they receive payments, you can make payments. You can see your account and see what they have about you. You could also work with a tax professional through power of attorney, and the tax professional can get access to your account different kind of access. There's a tax pro account, they call it. But a lot of times the issue can't be resolved online, but we can finally come to the problem. That's half the time with these notices. We don't always know what the problem is. And so when we write a letter, we don't always get a right answer because we're not necessarily answering the right question. But with these online accounts, we can get to we can easier get to the right problem. Also highly recommended a PIN number for identity protection. It's a different link, it's a different area. You get a 6-digit PIN and you'll put that on your tax return each year to file. So that way, with all the identity theft we're hearing about and people stealing, a lot of times it's first to file. Sometimes if someone files in your name and your social security number and applies for a refund, it's gotten harder, but that's what you're avoiding. You're avoiding someone else trying to do things with the IRS, and especially filing your return, a fraudulent return. One thing to note though is this is an annual number. So once you sign up for this, you cannot file your return without this number, and you get a new number every year. So just be aware of that. You don't want to be surprised, but I still highly recommend it. My wife and I do this. Makes me happy. If following this training, you go straight to this link and try to get a PIN number, you're going to get a message that says you can't because the system's down for maintenance till early January, and you'd be cursing me out if I didn't tell you that. So keep this in mind, make a note of it somewhere, set up a reminder, and go to this web. That's not the online account. You can do an online account now, I'm pretty sure. It's the PIN number. The system is down right now. And also 1099K reporting. This is a hot topic also. People who buy and sell, or just, if you're doing friends and family on PayPal or anything similar, that it avoids this report. That's not what I'm talking about. But in PayPal, they call it goods and services. Venmo, I'm not sure what it's called there or if it's any different. But if you're paying people, you're doing, whether it's business transactions, you're selling, not even business, but you have concert tickets that you bought, you can't use them, you're selling them, whether you're selling to a friend at cost or you're selling them for profit, whatever. The reporting is similar to a 1099. If you're self-employed, we've heard about 1099, I get a 1099. That's what this is. The third parties, the Venmos, the PayPals are required to give you a 1099K for any transaction over $20,000, or for any payer. It's not the recipient, it's not me, but if somebody has more than 200 transactions, then you're going to get a 1099K reporting this. And when you get the 1099K, so does the IRS. So what this is being used to match, because there's a lot of income, online income not being reported, supposedly. So this is trying to do a better job of matching and having people report their income. Then you have expenses, you can deduct those against it. But it's trying to get the more reporting. The snag though is that $20,000 threshold has been reduced to $600. So if you sell a concert ticket on PayPal for $800, you're going to get a 1099K unless these rules are changed. And that there are just so many of those. It's overwhelming. The PayPals have been fighting it. Individuals have been fighting it. People saying it's going to catch all these people by surprise. So the $20,000 down to $600 limit has been delayed. It was supposed to kick in last year. Supposed to kick in for 2023. It got delayed again. The thought, nothing's definite, but people are thinking it's going to go to $5,000 in 2024 and then $600 in 2026. But this is coming. But if you get a 1099K, if you're not in a trade or business, you're just, the example I use is you're selling concert tickets or even your used refrigerator, and you sell it and you get a 1099K, don't ignore it. There are ways you should report the income, but you probably have basis. You bought it for something. You bought that concert ticket for some price, or you bought that refrigerator for some price. So if you sold it at break even, you sell you report the income, you report the expense, the cost, and you don't pay tax. But if you don't report it at all, there's a good chance you're going to get an IRS notice for the amount of the proceeds as taxable, and you'll have to again back to, if you don't have to deal with the IRS, you're much better off. You'll then have to address that notice to get your cost. That generally does it on my outline. Some other quick, before I do that, I have just a couple quick things I just note that didn't make it. I thought about it last night and this morning after I finished the outline. If you're self-employed, if you are, whether it be through in a partnership, an S corporation, or or most likely a Schedule C, you get 1099s, or you're on a Schedule C. What's missed, what I call the 5 commonly overlooked deductions. We talked about meals. I'm going to just name them for a moment and then briefly talk about them. Meals, auto, use of your auto, business use of your auto, travel, computer and equipment purchases, and your home office. These are for, generally, this is where a lot of people, if you don't have an accountant, you don't have, accounting staff on hand, it's just you and your own self-employed. These are 5 areas that get overlooked the most, that I find get overlooked the most. Meals we discussed already. Everything needs to have a business purpose in these, what's called ordinary and necessary business expenses. Those aren't really defined terms, but they're kind of what they sound like. If you take someone out for lunch to talk business, networking, business development, you can deduct 50% of that. The who, what, where, when, why. Keep your receipts in order to document it. Auto, if you use your car for business, commuting is not deductible. Driving to and from an office, your daily commute is not a deduction. But if you travel by car a lot to go from place to place, we're seeing less of it. But if you are using your car a lot, the business use portion is deductible. We're not going to get into those rules. I'm just letting you know that. If you own one car for personal and business, it's generally not reasonable to say that all your driving is business use. So you want to allocate that between business and auto and personal. And there's also a rate you can use to take your business miles times the rate to get a deduction. Travel, if you're traveling for business, that's different than auto. If you are going to if you're certified, you're licensed in whatever you're going somewhere for a continuing education seminar, you're traveling somewhere for an annual convention in your industry, etc. You can deduct 100% of that: the flight, the hotel, the trip, parking. If you're taking an Uber to get to the airport, etc., you can deduct that trip. If there's some personal time, if you're staying longer, there are different rules. We're not going to get into that. But keep in mind that generally anything you're doing for your business and you're spending money on is deductible if it's for ordinary necessary for your business. Computer and equipment purchases, if you need to buy a new computer, a new iPhone, new Android, whatever, a smartphone, if a desk, furniture, etc., you can deduct that also. And then there's also what's called the home office deduction, which is generally you take the square footage of your office to the square footage of your home. It's a little complicated. And then there's also a simplified method with a rate. Just want to talk about those quickly, just point them out. I'm happy to talk later because I know we're running out of time. And then also the standard as for tax planning, specifically, if anything you could pay now, it's the end of December. If you have bills now that you could, if you're in, whatever you can pay now, you'll get a deduction for now. If you're happy where you're at and you're good and you want to, maybe don't pay it until after January 1st and push the deduction out till next year. But the rule of thumb is always pay what you can now and take the deduction now. Even consider it as appropriate, pay something in advance, rent, some of your January bills that you have to have been billed for already. If you receive the bill not due till January, pay it now, and you'll get the deduction this year rather than next year. Capital, if you have capital gains and you have capital losses for investing, try to match those. If things are already sold and you look at your brokerage statement, you have gains for the year, and you already have recognized gains, and you're sitting on some assets that you're not loving, and there are some losses, you can sell those to offset and work with a financial planner on that. But offsetting capital gains and capital losses, we spoke about at the very beginning. Maximize your retirement contributions if you can, and any charitable contributions. Again, back to the itemized deductions versus standard deduction. But I don't recommend people giving for the sake of for a deduction. Cash is king. If you're trying to maximize your cash, paying something is not always the best way because you're going to lose that whole dollar. But if you are able to get a deduction for it, and that's what you're trying to do, then it's a smart move to make these decisions at the end of December. Kind of rushed towards the very end because I wanted to make sure I had some time. I'm not going anywhere at the end of this, but if anyone has any questions, I'm happy to talk, happy to help. I'm going to stop sharing. And all right, there's everybody.
Great. Thank you so much, Barry. That was a terrific presentation. I did see that Aaron had raised his hand, I believe.
Yeah. Hi, Barry. Thank you. That was really interesting. I got a few questions. Most of this is just kind of repeating what I thought you said. On the 1099-K issue, which deals with transactions from online banks to myself, the current rule is there's a $20,000 limit, or I didn't understand what you meant by the 600 is postponed.
So the rule, what they were trying, what went into effect, but it's been postponed, is $600 limit. The current rule is right now $20,000, but it's not a total, it's one transaction. Or I guess if overall, like if you're using PayPal a lot, it's not one. If you're using PayPal and you have over 20,000 sales through PayPal, not goods and not family and friends. I'm not as familiar with Venmo and the others, so I'm going to talk PayPal language, but I believe it's appropriate with the others as well. All the transactions I make between my wife and I, or friends, I shouldn't use my wife, like my friend, I transfer them money because they're fronting me for they're doing something and I'm paying them back. It's a
Right.
personal expense, and they bought tickets for me. They didn't buy the ticket. I'm not buying them. I'm reimbursing them. When you do it through friends and family, that's not what we're talking about here. Those
Okay.
aren't going to be reported. But if I'm using goods and services, sometimes someone might make a mistake and send that money to a friend and not select friends and family. And they select goods and services. When you're over the $20,000 limit, that's when the payor is going to give the recipient. I'm receiving that money. I'm receiving the money. I'm going to give you a 1099-K. The credit card companies are doing this. The PayPal's, Venmos.
So is the 1099 issued by PayPal, or is it issued by? It would be issued by myself if I gave someone that money.
It's the recipient. PayPal, if I said it back, PayPal is giving you the 1099-K.
Right. Okay.
The recipient.
Similar to what you had said, in the course of a year, I could have more than $600 of payments, but it's not a purchase. It's either I put money in the account to hold it until I could buy a TV, and then I bought the TV, so I took the money out and paid myself, or as you said, like someone bought something for me and I'm reimbursing them for their expense.
Yeah, the transactions amongst yourself like that, transfers to and from the bank, those are not gonna. These are really, they're trying to get to the folks who are using PayPal, using Venmo for business purposes,
Okay.
rather than that's what they're trying to get at, is
Okay.
when you're in a business and it's no longer cash, it's no longer a credit card, and you're using these other services. That's what they're ultimately trying to get at, is to catch, not to catch, but to have that third party reporting to match with the IRS, so that way you're filing your tax returns and you have your sales.
Okay, so different topic. Thank you. Different topic, different question. Currently, I track business development related meals and entertainment as one line item. Should I be splitting that into two line items, with one for meals and a separate for entertainment?
Yes, because the entertainment is no longer deductible.
Okay.
What used to be, everyone tracked it. I wouldn't even recommend having an account called business. We all used to have an account called Meals and Entertainment. It was 50%, and that was the account name, Meals and Entertainment. Bigger businesses might have broken out differently. We're not going into that, but that's the idea. Now that account, as it's called Meals and Entertainment, that name on its own is a red flag, believe it or not, because it's got the word entertainment. So meals are 50% deductible. Entertainment is not deductible. You're still going to want to account for it. You're accounting for your expenditures, but it's not it's deductible on like a financial statement per se, but if on your tax return, it is not a deduction any longer. It is not allowed.
Okay, got it.
You definitely want to create a separate account, one for meals, one for entertainment.
Yeah. And often, I do field work. I have people out in the field with me. When we're doing a day of field work, I will buy everyone lunch. That's not for the same purpose as buying lunch for a client. You know what I mean? So I'm assuming
Correct.
that those field lunches, that kind of an expense is just a routine field operation expense, the same way as buying flagging or something like that would be, right?
Correct. To a degree, I want to say yes, with caveats that I'm not going to get into all the details. The general rule there is, when things that are items, deductions that are, or I should say expenditures that are for the benefit of the employer, are generally still deductible. So you're taking lunch, you're grabbing everybody, you're taking lunch for the team, you're paying for lunch because it's just making for a more efficient day. If everyone scatters and doesn't show up for another hour, you're preventing that from happening. You're talking about work over lunch. I don't want to say black and white. It's 100% deductible always. I just want to be careful with my words, but for the most part, the items that are for the team building and for the benefit of the employer are still deductible.
Got it. Okay, that's great.
If you're grabbing, if your team of 10 is together and you're grabbing one employee, that's different than the team.
Got it. No, that's great. Thank you very much.
My pleasure, Aaron.
Okay.
Hang on, Ross. Any other? I think I saw Ross had a question pop. Anybody else? I'm going to get to you in a moment, Ross. I just want to make sure I don't, if we get run out of time or something. Okay, Ross, I'm going to read. I think your question is, what is your advice in dealing with the IRS to understand and resolve IRS notices? Yeah, it's patience. You know, I used to joke many years ago. Here come the bad accountant jokes. Many years ago, I told people if I wanted patience, I would have gone to medical school. But now I need to have patience, even though I don't have that medical degree. And it's gotten hard. If you write letters, which is the easiest way to just respond to a notice, to write a letter, you may not always, you don't know who's getting it, you don't know who's processing it, you don't know if you're answering the right question. Letters are could be an endless loop because you write them a letter, and if you're not giving, if you're not resolving it directly in the exact problem and the exact issue, the best course of action is a phone call. Read the letter, read the notice, understand the notice, sometimes get help if you need it, but try to understand what it says, and the best advice is to call. Sometimes the notice says you owe money, take a look. Ooh, shoot, it says you didn't make your third quarter payment. I thought I did, but I didn't. The notice is right. Well, then pay it, obviously. But if it's saying they owe you, if they're saying you owe, they're saying you owe them and you disagree, a lot of times it's going to take, if it's an easy resolution, if they're saying you owe money because you didn't make a payment, but you know you did, that's the most common. They're going to want a copy of the check. They're going to want a copy of the front and back of the check. They're going to want a copy of the bank statement. You could white out a lot of it, and they're going to want to show that the money actually came out of your account. So if that's the case, you can make those copies and send that in a letter. If you call the IRS and tell them, but I did pay, they're going to tell you what I just told you. They're going to ask you to send it in anyways. So you can do that. A lot of times the answer is it depends on what the problem is, but in most cases, the most efficient way is to call them. The problem though is they're open, I think, at 8 or 8:30. I have a tax practitioner line that I can call as I need power of attorney. Either I signed the return, I have permission to call and talk to the IRS because I signed that year's tax return, or I have power of attorney. I think their line opens at 8. I call them at 8:01, not even. I literally call them at 8 and 12 seconds. And more often than not, the message already says, there are too many people on the call. Projected wait time is 30 to 60 minutes. I am lucky if I get that message. If I get that message, that means I'm in. Now, as a client, you're not going to pay that 30, 60-minute hold time. I already have plan B. I already got actual work I'm doing. I put the IRS on hold, not on hold, rather I put them on speaker. I put them on mute because I don't want them to hear conversation going on here. Speaker and mute, and I wait for them to pick up 30 to 60 minutes. Many times it goes over the 60 minutes. The absolute worst thing that happens, which also happens a lot, is after those 60 minutes, you hear some noises, boop, boop, you're being transferred. You hear boop, boop more, you're being transferred, and suddenly you got disconnected. That happens a lot. That's really annoying. Many times when you make that call, you're told all lines are too busy. Please try again. I would rather sit on hold for 2 hours, knowing sooner or later someone's going to pick up, and I'm at least I'm in, and I got you on speakerphone, and I'll ask a coworker to, I got to run get a cup of coffee or something. Can you be on the lookout if they pick up after an hour and a half? I would rather that than trying to constantly call back and get a message that says, too busy, call back later. So I don't really have a good answer for you.
What number do you call? They have a reference number in the notices, but you
That's
find
the number.
the wrong number too, when you.
Yeah, there's many you could use. Step one is to use the number that's in the notice. Step two would be to go online and see if there's some other phone number. There are field offices. If depending on what the issue is, you can go to an IRS field office. I
Okay.
wouldn't. Good luck making a phone call and trying to schedule that appointment. I believe the field offices have a local number. I don't know if you could schedule an appointment or if it's all drop in. And again, depending on your issue and depending on the problem, I forgot about that for a moment. Like I'm generally not going to a field office. So I don't think about that option as a tax professional. But if you're dealing with the notice yourself, all the cities have, there are a lot of field offices around, more than people realize, and pop in there. I wouldn't suggest going in at 3:50. Be prepared to give it a day. Who knows? I have no idea what to expect. Show up on it early. Don't show up at 11:50 when they're, I don't know what their lunch breaks are. Just think from their perspective for a moment. Show up early, bring a book, bring headphones, bring some Pearl Jam, and you'll have a good day.
And wait.
Yeah, exactly.
Okay, thank you.
Okay, anybody else have any questions for Barry? We will, following this event, share an email with some additional information. We'll attach the handout that Barry provided and include his contact information. So if you need additional help for your business, you can certainly reach out to him offline.
And anyone who's on here, if you didn't speak up because for any reason or another, feel free to reach out. I don't know if my email, my office phone number is on the handout, the 301 or the 410 office numbers. Just ask for me, or through the chamber. You can email me, and I'm happy to follow up, ask any questions, help you out if there was a topic that I flew over too quickly, etc. Or just something you had a question on. You attended this to ask a question, but then you didn't, for whatever reason, you didn't speak up. I'm happy to try to help out.
Yeah, we'll make sure everyone gets your email address, and thank you for that offer. Well, if we don't have any other questions, we can wrap it up. So I just want to thank everyone for joining us today, and especially Barry for such a great session. And we do hope you'll tune in for our future webinars. We have some great topics coming up in the new year. You can always find out more about our events at our website, which is centralmarylandchamber.org. We do have one final event for this year coming up this afternoon at 1 o'clock. It's our final Membership 101 session of the year, which is on Zoom. So you can log on to find out more about the Chamber and all your member benefits. Even if you've been a longtime member, I guarantee that you'll probably learn something new from attending Membership 101 because we're always adding new events and programs. So again, thank you again to Barry Fields and Bormel, Grice, and Huyett for such a great presentation. And I encourage you to reach out to Barry if you have additional questions. So happy holidays to you all and have a wonderful rest of your day. Thank you.
Thank you.
Thank you. Happy holidays.
Thanks, Barry.
My pleasure, Mike. Anytime.